The next style of trading that many traders have found success in is swing trading, which is sometimes labeled as a trend-following system. Very similar to day trading, swing trading involves the buying and selling of an asset over a period of a few days to several weeks to capitalize on medium-term fluctuations in price action. The primary difference between day trading and swing trading is that swing trading is executed on longer timeframes. This will typically reduce the number of trades that the trader may take, which may also lead to an increase in the quality of trades. Some factors that may affect price in this time frame can include earnings releases, news updates, supply chain inefficiencies, and other larger scale events. It is important to remember that in these higher time frames, the position is usually based on much larger scale events and information. One major difference between swing trading and day trading that I would like to point out is that swing trading typically involves a greater understanding of the underlying asset, since profits are more closely associated with company performance. Day trading, on the other hand, focuses more on the technical aspects of trading, while swing trading focuses on the more fundamental aspects. As I was hinting towards, one major advantage of swing trading is the potential for massive profits. Since the positions are executed over a longer period of time, there is a much higher ceiling of profit potential as opposed to a single day. In addition to this, swing trading typically requires less of a time commitment since position analysis does not focus on the technical aspects of trading. Instead, swing traders will analyze company earnings and news events, which will have a much greater effect on their position. While a day trader would typically do market analysis every trading day, the swing trader may only allocate 1 or 2 days per week of in-depth analysis to understand when to enter and exit their positions. The swing trader does not care so much as to what happens within a day, but more so cares about what happens within the span of multiple days or multiple weeks. As I had mentioned, another benefit to swing trading is the potential increase in quality of positions since they are less frequent. This can allow the trader to make smarter decisions, which can ultimately lead to more consistency in the future. Remember decision fatigue. Humans cannot physically continue to operate efficiently over a long period of time. It is only a matter of time until we lose our focus, lose our strength, or lose our energy and are simply unable to read, process, internalize, and express information as efficiently as we could have. This is essentially eliminated altogether in regards to swing trading, since the trader may make only 1 or 2 major decisions in any given week. Still, it is equally as important to understand the implications that come with swing trading, with one of those being the overnight risk. While day traders do not suffer risk from overnight events, swing traders do, which can easily eat up profits or feed the trader some losses. This increased risk can lead to an increase in emotional and psychological pressure, as waking up and checking your position can be seen as a gamble, so to speak. It is impossible to know all the information that is coming into and affecting a specific market, and as humans, we all need to sleep, eat, and spend our time doing other things. So, while swing traders typically spend less time watching charts, they may have less control over their positions as the individual may not be able to look at and analyze their active positions at any given time. Another point to consider is the high amounts of capital that swing trading requires in order to realize a justifiable amount of profits for the length of the trade. While day traders can place a large amount of trades within a given week or a month, swing traders may only be able to take a small selection of trades within a given week or a month, as they do not have the capital to afford any more. This, of course, depends entirely on the trader's portfolio size, which may be large enough to eliminate this drawback.